My name is Morgan Mason. I'm a second-year MBA student, and I'm really passionate about entrepreneurship because I think there's a thread of passion behind every entrepreneurial idea, which drives all the creativity and the variety of outcomes. Up next is our afternoon panel, Investor Perspectives, in which we are fortunate to have 3 investors with experience ranging from early seed and seed to Series A and private equity. Our host for this panel, Beth Chase, BA, class of '85, is a board director, strategic advisor, and entrepreneur with a career in driving transformational change across industries. Beth founded C3 Consulting, growing it to $30 million in annual revenue and becoming the largest consulting firm in the Nashville area prior to selling the firm to Ancura Consulting Group. Beth currently serves as an independent director on 2 corporate boards, Ingram Industries and Tolco Industries. She also spends time mentoring early-stage entrepreneurs and emerging leaders. Beth, I've heard your name many times in Nashville, and we are thrilled that you are joining us today. I'll let you take it from here to help introduce our panelists.
Thank you. Can everybody hear me? Thank you so much. Wow, what a morning. It's been so inspiring to be here and to listen to all these entrepreneurial stories. I hope you've enjoyed it as much as I have. And today, for this panel now, we're going to be focusing on the money side of entrepreneurship. And I'm just delighted to have these great panelists here with me who are really experts across the capital continuum. And they're going to share their experiences, not only their journey and how they got into their careers, but what investments do they look at? What's hot, what's not? And what do you need to be thinking about, whether you want to have a career in this field or whether you want to invest in entrepreneurship. So let's get started. I would really love to have the panelists introduce themselves, and we're going to do that really by stair-stepping into the capital continuum. I would love to start with Alana Mann. She focuses more on seed funding. And Alana, can you give us a little bit about your background and the kind of scope and size of businesses that you're looking at today and investing in?
Of course. Great to meet everyone. My name is Alana Mann. I'm a principal at Cultivation Capital. We are an early stage venture firm that focuses on a variety of key areas. So we have groups that look at everything from healthcare and life sciences to geospatial technology. We have a team that looks at also earlier kind of seed, and that's called Spirit of St. Louis. And then we also have a team that spends a lot of time focused on agriculture tech. I spend all my time on the enterprise SaaS side of things. And for us, that really means, any business across the industry agnostic that has a true B2B recurring revenue business model we'll look at. And we say we're kind of late seed, early Series A, which for us means that any business that's nearing 1 million ARR in terms of revenue threshold.
Awesome. And Vanderbilt grad?
Yes, and a Vanderbilt grad 2015. So go Doors.
Awesome. Thank you so much. Joe Maxwell, give us a little bit about your background and where you spend your time.
Great. Joe Maxwell. I was a 94. I can't believe Owen let me in, and I'm probably one of the bigger embarrassments while I was there. Wasn't a big fan of school and had a good time. Learned a little bit. Was unemployable entrepreneur. Most entrepreneurs, I hear a bunch of people talk about, I grind and I do that. Well, no, most of us are unemployable because we're hostile, disruptive, difficult, all the things that I was my entire life.
Unmanageable.
And I was for Owen. I don't know where Eric is, but I was very disruptive for him. But I was a serial entrepreneur. Beth and I were cutting our teeth at the same time. I mean, shoot, we went through the journeys together. In Nashville, stayed here, was always in fintech, found something called the internet, 93, 94, got hooked on the first browser, built a big fintech company on the internet. Banks didn't even know they were on the internet. I was a hell of a salesman. Built that, scaled it, sold it, built another one, scaled it, sold it, built another one. Just couldn't help myself. And then I turned to the investing side about 5-6 years ago. Saw fintech, was like, wow, we are in the top of the first inning. Because guys like me, we built all the rails that needed to be rewritten. So we were seeing everything coming. So been in the fintech investment, started a firm called FinTop Capital. We have about 35 portfolio companies across 5 funds. Has really scaled nicely. We've got a whole team now, got about $750 million under management. Mostly Series A. We saw all the really good operating-led funds that were Series A. They all went upstream and raised these big funds. And I was sitting there going, wow, there's a real market for SaaS. It's all B2B SaaS, very focused on fintech. So that's what we do.
Great. Looking forward to hearing more about that. And Chris Mioton with Shore Capital, give us your background and really more about what Shore Capital focuses on. We'll get to the background in a minute.
Sure. Chris Mioton. I studied econ. I did get my MBA, unfortunately not at Vanderbilt. Career in investment banking and private equity. At Shore Capital, we focus on the lower middle market, which we define as companies that start with 1 to 10 million of EBITDA. Typically, we're the first, 90% of the cases, we're the first institutional capital, so we're still dealing with founder entrepreneurs just a little bit later in the capital stage, as Beth mentioned. Heritage of the firm was we focus exclusively on healthcare, and the thesis was 12 years ago, let's prove out this model in the lower middle market and ultimately diversify into other sectors. So I focus exclusively on healthcare, but we also have teams that do food and beverage, business services, real estate, and perhaps down the road, maybe another sector or two. We have $2.7 billion under management across multiple funds. Equity check sizes can range from anything from 10 million to a couple $100 million, depending on the fund that we're investing out of. We're based in Chicago. We have 80 people on our team. Given our kind of operational focus, we're pretty hands-on with our portfolio companies, and we opened an office here in Nashville 2.5 years ago. Very fortunate to work with Michael Burcham, who I know is very involved here with the Entrepreneur Center.
Awesome, thank you. And Joe started talking about his career journey and a serial entrepreneur, and then decided to get into the investor side. Would love to hear from both of you, maybe starting with Alana. What caused you to get into this field, and talk to us a little bit about your career journey.
Yeah, of course. Definitely a very unconventional path into VC. When I was an undergrad at Vandy, they had just started launching up all these new kind of clubs and extracurriculars to get involved with the entrepreneurship center downtown, as well as accelerators, incubators, and so did a lot of that and was like, okay, well, I think I need to get a lot more domain expertise and build up this really strong, deep kind of industry point of view before launching my own venture. So after graduating from Vandy in 2015, I went the long way into being an entrepreneur. So started at Saks, went through their kind of executive excellence program, all that time spent in kind of the buying office. And then right at the end of the executive excellence program, the cool startup in town, Jet.com, reached out and they're like, do you want to join kind of our category manager program? And Jet had just been acquired by Walmart eCom. Mark Laurie was doing all these really exciting things there. And so made the leap into the startup world at kind of the most de-risked, exciting startup you can join at the time, and was able to just be really entrepreneurial. You had all the kind of the Walmart tech hub ecosystem really kind of powering you in that role. And then at my 1 year mark, I was like, oh, I feel like I've seen it all. I just want to take this leap of faith now. Very naive, very ambitious, and probably the biggest, challenge reconciling, okay, going from a huge, well-fueled, highly capitalized startup to doing it on my own. And so took that leap of faith and launched my venture at the time, which was focused on sustainable fashion and making it more accessible and affordable to millennial women. Spent a lot of time figuring out, how could I dedicate my time to customer discovery and building out and pivoting with the product, having a small team, and then kind of started learning about this thing called venture capital for the first time, and was like, oh, this sounds awesome. I want to build a venture scalable business. My business is going to be a public company one day. I need to raise funding. And really very quickly realized the challenges of being a first-time founder, and specifically how impossible it was to meet VCs, network with VCs, find angel investors, or find anyone who wanted to talk with me. And it was so odd to me that, at the time there was like this big push of like closed loop systems, everything becoming more open, and kind of this idea that knowledge on the internet, everything should be accessible to everyone. But VC was really benefiting from this closed loop system. And so I was like, okay, well, I'll just focus on educating myself about VC as much as I can, share this with kind of like my entrepreneur friends and circles, just so that I can figure out how to do this thing for my business. And very quickly identified a lot of the problems with VC and was like, I think I could be better suited to potentially correct this as someone who's been on the other side, knows the challenges firsthand, and I'm definitely someone who, if I see a challenge that I think no one is solving, or I feel like maybe I'm uniquely positioned to help fix, I want to do it. And so I was fortunate, because of my background in consumer and retail and e-commerce, to get a role in portfolio support at a fund called Startup Ventures, and was helping some of their retail tech startups. And then they were like, hey, do you want to come back as a summer associate? And I was like, yeah, sure. Like, I ultimately want to get more involved with investing anyway, so that's a perfect fit. And then went through this program called Going VC, which I highly recommend for anyone interested in breaking into VC. They do a lot on the educational side, but they also give you the resources to, be involved in their investor program. So scouting out deals, being able to lead deals from, sourcing all the way through pitching an investment committee. And then, Going VC was like, oh, we're launching like this new program focused on people who are like top of the investor program class. Do you want to do it? I pride myself on always saying yes to things, which sometimes gets me into trouble. But did that and was able to then kind of do some, back office work for external funds that had reached out around diligence memos. So leading up diligence processes for some of these like super angels who just didn't have internal support or time. And then was fortunate in November of 2020 to join Cultivation Capital. And so, yeah, it was definitely a very long, tedious process. I know there have been a few panels today discouraging people from breaking into VC, but I will say, like, the one takeaway that I had is, like, sometimes the hardest things to do are sometimes the most worth it. So I just feel like super humbled every day that, the job of being a VC is largely about investing in inspiring entrepreneurs who see the world differently and either believing in their mission of how they see the world or wanting to support it. And so I think that's kind of the takeaway. My intro probably went over on time, but
That's good. No, you did great. Thank you. Very interesting to hear how you ended up in the role that you're in today. Chris, give us a little bit about your journey.
Yeah, I wish I could say I had this vision as a kid where I wanted to be in private equity, but the reality is my dad was a doctor and he dabbled in investing in the public markets on the side, and I started to think about, what makes a good investment, what's a good business. As I mentioned, we had econ, but no finance or undergrad business at Northwestern when I went to school. And I had a good friend who became a mentor who was in the investment banking club, and I came to believe or think that would give me a good business toolkit coming out of school. So I went into investment banking, and just really fortunate I shared a cube with a guy by the name of Mike Cooper. Mike left and went into private equity. I followed him into private equity, and the reason why I did that is in investment banking, to me, it was a great experience. A lot of responsibility right out of school, but it was very transactional. And I wanted to be able to have an impact, a responsibility, and accountability to helping create value at companies. So made the jump into private equity, and then obviously followed Mike, who became one of the 4 founders of Shore.
Awesome. I'd love to hear your advice. There are a number of students in the room. What's your advice if somebody wants to get into the VC or private equity world? What should they be doing now in terms of learning? What should they be doing in terms of networking and action? Any thoughts from you guys?
That's a good question. I love what you did. You hopped in. There's a lot of folks that go intern. If you can get in any experience to look at deal memos, writing new deal NDMs, new deal memos, doing due diligence, understanding the models, because the most important thing is get educated on T's and C's, terms and conditions. I mean, there's a whole different language you speak in venture that, unfortunately, business schools are horrible at teaching it. No offense, Eric, sorry. Little plug. But when you try to make this an academic exercise, it's really hard because each deal's different. It's got its own life. And when you can get an intern or somebody that speaks deal logic and you can throw that work to them and get that experience in venture, it takes you to the top of the heap in the kind of, because here's the problem. You get a bunch of folks, 2 years banking, blah, blah, blah. You know, they come out and they want to get
Boring.
in venture. You make too much money. I mean, that's the problem. You
He
make too
didn't
much
say
money.
boring.
Like, it's you sit there and you're like, yo, dog, you got like a $300K bonus last year on top of what you made because you work in New York and people pay you a lot of money for doing whatever you do, doing PowerPoints and doing some modeling. And, you know, I'm joking, just being facetious. But if you can come up from underneath and grind, and you can actually get into venture out of undergrad. It's amazing how many, like we just hired this young kid from University of Kentucky, Cooper. He starts in May. He spent the last 3 years in Louisville working at an accelerator, and he does all their NDMs. Like the kid's experience. And we interviewed him, and we have this whole interview where we pull him in and we start talking about deals and what does that mean? You know, what is a participating preferred with a 1X preference versus straight preferred? How are you going to refresh post or pre on the option pool? Do you split it? Where do you hit the lever for this on getting the deal value? And the kid was unreal. I mean, like, he passed with flying colors. And I'm like, all right, we're going to hire him. So I just think experience, you know, getting on any, you know, the great thing about entrepreneurship and especially accelerators, innovation hubs, they love interns. And if you can get in and learn, VFA is a great program. Venture for America, Andrew Yang's program, your program. I mean, there's some really interesting programs out there that get you indoctrinated early to get into venture.
What else comes to mind?
I would add the biggest recommendation I always have is like get in front of founders and get in front of other investors. Because if you think about like the crux of what is so crucial to being a great investor, it's like being able to find the best deals, being able to win the best deals, and all of those things really tie down to your ability to like have a strong network that can, one, maybe be intros to potential customers if it's, you know, a company that is in a space that you're really well versed in, or, you know, for example, a ton of deal flow that we'll do comes from other funds. And so if you have those existing relationships, it shows that on day one, you can hit the ground running. And the other piece of getting in front of founders is founders should be your best advocates. When you might be interviewing with the fund, they're gonna ask around in their network, you know, who knows her? What's their opinion of her? What unique, you know, value prop would you say about her that could be beneficial or complementary to the existing skill set on the team? And so much about venture is these kind of small teams where each person is like, you know, a very crucial part to how the team can move forward and think about not just, you know, this current fund, but how do you build a franchise of really successful funds? And so I think like really being able to hone in on network and how you can really differentiate yourself to founders. Because especially in today's markets, I think we all can agree, like founders have a ton of autonomy and ability to really decide who they want to be on their cap table because there's so much capital in the market. And so if all of these deals that might have been less competitive, you know, in the early 2000s are now super competitive deals. And to win those over, you have to have a really strong reputation, a really strong network of how you can be really beneficial to that company moving forward.
That's great, thank you. Chris, any additional thoughts?
Yeah, I think knowing your relevance. I mean, you met one private equity firm, you've met one private equity firm. You know, what kind of firm do you want to be part of? Coming when you're doing your networking, understanding their strategy and how you potentially fit into that. And then I think there are other avenues into private equity or venture capital too. I mean, we've got a big operational team where that's an avenue. Our portfolio companies, you mentioned internships, they also have internships, and a lot of our portfolio companies in particular are highly acquisitive. So some of the deal terms that you're hearing Joe talk about, I mean, our portfolio companies speak the same language, so at least that's an avenue to get it on your resume, get some experience, and then that next conversation you go have with a firm can be more informed.
Yep, it's great. We're going to do a couple of rapid fire questions in the next 40 minutes or so, and I'm going to start with the first one that'll sort of end our career part of the discussion, and we'll move into investing and what you're looking at. And perhaps a controversial question. Sorry, Eric, but I'm going to ask it. You know, from your perspective, I think we've got undergrad as well as Owen, you know, MBA students in the room. Is it critical to have an MBA on your resume to get a job in your field?
Hell no.
Let's just hear from your cards. Put your red means no and green means yes. Oh, well, give us some. So he said hell no. Why?
It's great to have it. It's a piece of paper. It's great tools. You prove you can get through it. But when you brandish it as if you're a peacock and you're proud of it, it downgrades you. Look, the best companies I have are founders with maybe some college. I'm dead serious. Like some college, it gets through to me. Like, do they have some college, a little junior college, a little something? Let's look at it. Because their business dictates it. I mean, I saw some entrepreneurs here earlier. It's like, at the end of the day, entrepreneurship is brutal. It is not a sexy path. I mean, I've been there. There's so many entrepreneurs in the market today that just in love with the concept of being around all this. And you're like, yo, dog, what are you gonna do when you've got to tell your 5 employees that there's no money and there's really no money, and how are you gonna grind to the next 2 weeks, 3 weeks? I mean, you've been there, Beth, we know it. It's tough. So when you're picking, when you're looking at this field, and you look at the most successful people, at the end of the day, business school was good for me. We were in a recession, so it was a good place for me to hang out for a couple of years. It almost does, it's better to have people find out you have that pedigree.
Gotcha.
I don't know.
Rather than putting that forward.
Yeah, putting it out front.
Yeah, any additional comments?
I always tell people, like, do what's authentic to you. So I know the premise of this question is yes or no, but it's like, if you feel that you would benefit from it, I would never discourage anyone. But I think in terms of the industry and what you can contribute, that's not going to differ whether or not you get an MBA or not. I think, especially VC and the world of entrepreneurship, everything is so results and performance based. You can literally see your metrics, even if someone is, trying to BS, and it's like you can go to Google Analytics and see their numbers, and you can see, okay, they're actually spending money on customer acquisition. So it's so easy for everyone to have visibility into how well you're really doing. Even as a fund, even as on the investing side, as well as as a startup. And so I think a lot of times people just want, it's kind of like that phrase, like, show me the money. Like, people will believe you if you consistently say, this is what I'm going to do, and you exceed that milestone, as opposed to saying, okay, I went to MBA at wherever, and I set this milestone but didn't hit it. Like, I think that is when it's kind of like, okay, you're relying on that to make your resume look more prestigious, but you really have to just hit these milestones, really show up and exceed expectations, not just amongst your peers, but of yourself. And I think a lot of times that comes from a deep level of scrappiness and resilience, that sometimes it is the underdogs who might not have even, gone to college, who have this level of scrappiness that makes them really unique. And the funny thing is, if you're really scrappy as an investor, usually founders are going to see that and be like, oh, something about them is entrepreneurial, something about them I can relate to. And so you have deeper relationships with founders, which then pays dividends when they're thinking about the next round of funding. And they actually, no, we want to do an internal round because you're awesome and you've been with us and supportive, and I can trust you, as opposed to taking a bigger PE round or whatever. So I think you just never know, but really my kind of thinking is, do it if it feels good for you, but know that you don't need to if you're someone who's scrappy, resilient, and just going to make it happen regardless.
Right, great advice. Chris, you have your MBA.
Yeah.
So give us a perspective
And
here.
we've got a mix of investment professionals who do and don't. I'd say as a firm philosophy, I mean, a lot of this business is an apprenticeship business. You're going to learn it on the job. If you've already gotten to know somebody, hired them, they know how you think and the way you work. We don't believe that you need to go back and get a piece of paper just to have a piece of paper. You've proven you can be successful within our firm. There are still some private equity firms that do kind of require it. Like they force you to leave and get your MBA, and maybe there's an option to come back, or they sponsor you in some kind of way. I do agree with Alana, and I think it's a personal decision. Where are you trying to get to in your career and professional development, and how is an MBA going to help you? Is it 2 years to be working on a business idea and be networking with other individuals? Is it a general management exposure that you want to get So I think it's a very individual decision in that regard.
Yep, it's great. Thank you. Before we get into the investments, Joe, you made me think of this. So give another rapid fire. Give one word that describes an amazing entrepreneur to you, that one characteristic.
Curiosity.
Unique.
Unique?
Passion.
Yeah, and I would say grit. You guys were talking about that, grinding that out, and I think grit is a key piece to that as well. Excellent. All right, let's go into investing. You guys are you probably looked at thousands and thousands of deals individually. What are some things you're looking at in new investments? And you guys can just kind of, anybody can answer and talk amongst yourselves around that. What are you looking at?
We're very thematically driven. We have some themes that we're investing in right now, and themes change, and there's new themes. So we have these corridors when we look at deals. So kind of bird dog and themes first, and then I look for capital efficiency. It's my number one kind of keystone.
Break that down for me a little bit. What does that mean to the
An entrepreneur will come to me, they've been at it, they've raised less than $2 million on a note. That's our magic number, 1.5 to 2. And they're at 600 to 700K, $1 million of recurring revenue. They got product market fit, they've pricing, they've fired a founder, they've been through a lot of the gosh awful things you do. But if you look at the efficiency in which they were able to obtain customers and get market traction, and unfortunately, that's only about 5% of the deals I see today. The average deal we see will have raised $15 to $20 million to get to $1 million in revenue. And you're like, because there's so much money and there's so much bad behavior, there's so many people slopping term sheets at these egregious valuations. And the problem is, I tell founders all the time, I say, yo, when you take that and you're sitting at a $40, $50 million pre-money valuation and you haven't even gotten to green yet, you got to live with that valuation and you can't raise money again. Like, it's great if you're that 1/10 of 1% that can create a triple double. That's growth percentages. But most people, it's really hard. It takes 7 years to build one of these businesses. And I kind of look at life in 7-year chapters. And people think they can get to these things in 2 years. And you're like, this is brutal. And they'll take money at too big of a valuation. So that's why I said we look for that CAC, the efficiency of how much revenue can they create for every dollar of investment. And we kind of put a ratio in there. And then we watch them. And then we see if those growth rates, was it an uncle that worked at the Guardian that hooked them up with a contract, or is this like sustainable? There's
a real customer.
A real customer, and so that's first we look for. I mean, we assume the business fits our theme, and then we look for efficiency first.
Right.
Yeah, no, capital efficiency is really important to us too, but haven't seen too many of the raise 15 million before getting 1 million ARR deals.
I'll send you 50 of them. It's a quick delete on my inbox.
And she'll hit delete as well, yeah.
I'll
respond
forward.
to those. No, but I think founder market fit is really important. In the world of enterprise SaaS as well, it's like really great to see founders who have some strong sales ability to either maybe even getting to that 1 million ARR. It's been like founder-led direct sales, and now they're just kind of at this great inflection point where they can build out a sales team and a sales playbook that is really repeatable. And so I think that's like the second big one, like, okay, how have you figured out like sales repeatability? And that directly ties back to also like capital efficiency. How do they know that they're going to use the funds and really allocate to hit those milestones in a way that makes sense and isn't just numbers on a paper? And I think that comes from like the really understanding repeatability of sales motion. And then I guess the last one I would say that we look at a lot is how are you thinking about more broadly your team, and how does that relate and kind of directly tie back to the ability to kind of hit these key revenue milestones? And that again like relates back to just kind of sales and the repeatability of sales.
Execution with the team.
Exactly.
Right. Chris, additional thoughts?
Yeah, very similar to Joe. We're thematic. We think about it like a strike zone, so to speak. There's certain pitches we're looking to hit at any given time. Every partner's looking at 5 to 7 different niches. In my case, within healthcare, if you bring me a healthcare IT, it's a pitch out. Like I delete for me, like just not the right fit, or I'll think about somebody else in my network it could be a fit for. And then we take it down the funnel to a scorecard. So every niche is going to have its own attributes that we're looking for. In urgent care, it could be rural versus urban or payer mix. And then it gets down to that entrepreneur owner that we're going to be partnering with. We do a lot in provider-based businesses in healthcare, multi-site healthcare, quality of the medicine, reputation, but most importantly, the vision and alignment thereof. The businesses are going to change dramatically under us, whether it's de novo growth or acquisitions, but starting with that right foundation is absolutely critical for us.
How much does cultural fit?
It's huge. I mean, we sell against ourselves. We spend a lot of time getting to know somebody in advance of actually consummating a partnership. I mean,
We tested.
You do.
Oh,
you run them
we
through
put
a
the
test.
chum in the water. We set them up to see what their real
Not
what
an
their real
official
fabric-
online test,
Not
but it's
online.
a human dynamic
We won't
test.
do a deal until we've been physically with them, like a 24-hour period. And we'll set them up. We'll take them to, they don't know they're being set up, but 'cause
Everybody
we
in the
wanna-
room knows now, so if they're going to.
You should know. You're being watched. I mean, we want to see what's core. We look for a lot of we and us. It's the I, me syndrome. That's what you're really looking for. When they come to the first pitch, you don't send them an agenda to see if they show up with their team with their own agenda. If it's just a founder that shows up to chat with you for 2 hours, you're like, yo, dog,
Right.
like, that was not a good move. Like, we wanted to see, because that's a test. Like,
Yeah, everything's a test.
everything's a test. It's like, what I love is the founder that brings the 5 other people. They come to a meeting and the founder's talking, and then the CFO will be like, shut up, Joe, he's lying, that's not true. And where they're just dogging each other, because that's that cultural, where you're seeing that they have the vulnerability of a team to just go after each other.
Yeah,
and
that's
because
great.
those are the teams that are going to get through this together.
Well, so let's talk about funding a little bit. When is an entrepreneur ready for funding? And there's all kinds of funding mechanisms today. There's a big continuum. Your options, each of you, but also crowdfunding. I see that you're connected to WeFunder in some way, and that's a new emerging opportunity. So when is it time to get funding, and what are some of these new creative funding options, maybe that you don't offer, and maybe that you do?
I guess I'll go. So I think that one's interesting. I think, for entrepreneurs in the room who may be new to this, know that there's pre-seed investors out there, there's true seed investors, early Series A, every step of the, capital fundraising stage, there's now a good amount of investors out there if you want to go the VC route. In terms of what a pre-seed investor might be looking for in terms of criteria, I can't really speak to that. But what I would always encourage founders to do is it's never too early to start building relationships. And if you think about it, a lot of kind of Joe's point earlier is we are watching. And that sounds really creepy, but we are watching. So if you can build a relationship with us early, we can watch you for a longer period of time. So in that time period, we're able to build up more data points. We're able to track, okay, these are the milestones that this entrepreneur said they would hit when I first met them 12 months ago. Now they've exceeded them, or maybe the month-over-month growth is now 3x faster. All these things can really help power the dynamic for when you do need to fundraise. So it's really beneficial sometimes. And not all VCs are super open to meeting founders early, but more of them are. And so I always say never too early to reach out to someone, but make sure when you are reaching out that you have a deck, that your deck is super clean, your value proposition is super clear. A ton of times businesses will pivot and things will change, but at every point that you meet and have a conversation with this investor, make sure that it's super clear what you're building, why you're building it, what's your unique point of view on this market, and what makes you uniquely positioned to execute on this business to become a market leader in the space, right? Because venture investors are not looking for, sub $100 million exits, right? We're looking for, unicorns, billion-dollar exits. So it's really make sure that if you want to go that path, that you're able to, even at kind of that pre-seed really early conversation, have a clear point of view of why you can do that in this decided upon market, and how well you know the landscape to really compete and be competitive. And then I guess the second half of that question was like, what are other funding mechanisms? Crowdfunding is a really cool concept if you think about all these consumer businesses that might have been historically, I won't say frowned upon by VC, but VCs have shied away from. Crowdfunding is really dynamic in the sense that you're now powering your customers and your earliest and most loyal customers to have some upside in your business. So I think that's a really cool dynamic that is now entering the mainstream, and it'll be exciting to see how that empowers more people to get access to capital in these earlier stages, and just kind of more diversity in terms of businesses that are able to get to a point of scale. Because you'll look at the metrics. I know the investor track earlier, we're talking about the disparity in funding to female founders, and those numbers we want to think that VC can kind of salvage those numbers, but I think a lot of times there are also great other resources for raising capital, and crowdfunding can be one.
That's great. Thank you. Chris, you invest in founder-owned businesses. When the founders deciding to take money from you, what's that timing look like, and what are they really, what's saying that they're ready?
Yeah, we're down market quite a bit. So if I had to guess, the vast majority of our businesses have been around probably for 10 or more years, and they're family owned or doctor owned.
Yep.
But they see this opportunity for growth or some kind of disruption that's happening, and they want a partner to help them address that, whether that's, it's a combination of de-risking and also growing. And there is this tension of frequently they feel like there's more growth next year. Like, let me get to that point and then I'll find a partner. So part of our mantra is just bigger, stronger, faster in a lower risk environment. Like, we've got operating partners. We'll add 6 independent board members to every board that add value. We've got 40 people internally, a head of technology, a head of data. We can bring all these resources to bear, and we show the track record of here's the growth that we can drive, and we can kind of put that against the rollover equity that they have and the reinvestment of the business, so it can be pretty compelling.
That's great. What's the biggest difference that you see in successful businesses in your portfolio? What are some characteristics of most successful, maybe least successful?
I kind of measured at rate of change. The most successful businesses in our portfolio, and we've had some really successful big ones, have been the ability to recognize the headwind and pivot really, really quickly. The rate of change. I look at entrepreneurs at the speed, not their ability. Most entrepreneurs are adaptable and can always change, but the speed in which they read it and smelling the money. Like, whether it be pricing, whether it be distribution, being able to really hit the blitzkrieg and go, and then marshal the team, reduce scope, increase focus, turn everything else off, don't pay attention to the next new product. Most entrepreneurs are tinkering madmen.
Yeah. We want to keep creating new.
They want to create new products, and like the most successful entrepreneurs are the ones that are like, I don't give a crap about the 10 new products that we could build, because until we have 15% market share in this one, we're not going to do anything else in this business. And to go back to that repeatability, the scalability, the growth, the profitability, because you get so much better on unit economics when you focus on one. And that's a real difference when you're studying entrepreneurs. I meet some of the most brilliant entrepreneurs I've ever met, but they don't complete anything. It's like, because there's a lot of entrepreneurs that are really good at starting.
Yep, that's just innovating.
And they're innovating. And then there's those that are just dog with the bone, like nothing will stop them. And I really study that.
Yeah, that's great. The rate of change and the ability to focus, single focus. Other
and the ability to raise prices.
Yes, that's
entrepreneurs give away way too much
we
value.
do. It's terrible.
We do. You have to. And like, that's my first question. How much free stuff have you given away? Because you have to. Like, if you're going to tell me everybody's paying, everybody buys, I've never given away product. I was like, you're lying.
Pricing is so key.
Pricing is so key. You
absolutely.
know that.
Other thoughts on success?
Joe mentioned it in terms of the pitch, but I think where we've had maybe some slower growth or more challenges is honestly we didn't get the team right in the early days, whether it's that specific role in the CFO or how the CFO works with the CEO when you're working against a 5-year plan, if you get 12 months into it and you realize that and you have to reset, as well as just investing ahead of the growth. In the early days, honestly, at Shore Capital, I mean, we had a different investment structure. We were high net worth, friends and family, and based on our learnings, we call it the J curve. We overinvest. We're confident the growth, the 5-year vision is going to be there. So we'll build a pretty big infrastructure knowing we're going to grow out of it.
Yeah, that's so important. And entrepreneurs are so scrappy prior to the investment that they're not used to taking that investment and then moving at a faster speed, right? So those two things are really critical. Anything you would add, Alana?
I would add 2 things. So I think one, the best founders are good at fundraising, and it sounds weird to say, but there are a lot of really strong founders who aren't. And I think that was one of the things that I was most surprised when I joined VC, because you just assume, oh, all these founders have gone to 1 million in ARR, they're really great at sales, you've seen all these product demos, and then, you might sit with a customer and they're like, yeah, I wish we would have done that with, one of his sales teams. He's just not good at sales. And so you have all these different dynamics of what founder personalities look like, but the fundraising piece is the biggest one, especially, as early stage investors, we are betting in your ability to bring in, capital in these later stages at an expedited pace of growth and, and to really accrue value, right? And your ability to build value at every stage of the capital continuum and build strong returns for our business, right? That's kind of the bet. And so I think founders who are good at fundraising is a big piece of that. And then I think the second one is coachability. A lot of times I'll be surprised on intro calls. You can kind of notice these little pieces of people who are so set in their ways and who obviously know the most about their business, but are not coachable. And that is a really difficult dynamic when, in a lot of examples, I mean, on our tech funds group, we've led 90% of the time. So if we can't, work with you and coach you and, know that we're going to be potentially on the board with you, that's a really difficult conversation and relationship to kind of mature and grow and see longevity with. So I think coachability is a big one. And so much of that just comes back to, ability to listen, ability to be self-aware, and deep-rooted, it's about emotional intelligence. So I think that's a really important
a really good
one.
point. Yeah, those are 2 great ads. Thank you. So important. Yeah.
One thing to entrepreneurs out there, that I can't iterate enough how important it is, the constant follow-up. When you find the VCs you really want at one day and you've got 10 of them, every quarter send them an update. We measure that. We measure the entrepreneurs. We have a whole dashboard. They're like, wow, these people, they communicate every quarter, every quarter. And the other thing is when you're trying to get a meeting, don't cold call, because it's just so hard. I've got a million, and there's no entrepreneur I don't want to help, because people help me. Trust me. I mean, you've got to pay it forward in this business. I started with nothing and had to fundraise I've been fundraising my whole life. And you have to be good at it, but find their network, work hard, because you were talking about a good fundraiser. A good entrepreneur who's a good fundraiser is going to find someone close in a network of the person, and you're going to have Beth get introduced to me through a friend of, because when Beth emails me, I'm like, yeah, Beth, she needs help, and I'm going to respond. And I respond immediately because there's just this camaraderie of entrepreneur to entrepreneur. We scaled together, we exited together. There's just that
warm connection.
Yeah, there's a warm, and it just work it and find a way to get into the network. When I get cold calls of the email, the inbound deal flow, I don't look at it.
I don't know, Andrew East, he was really working it. He had a lot of cold emails and he was getting results, but that's hard to do. It's certainly better to have that warm connection.
Yeah.
I will add one thing. So I actually am kind of on the opposite side here, because I do believe in cold emails, because I think a big part of historically what has made VC so difficult for entrepreneurs, female founders to break into is this kind of reliance on the warm intro. And so I always will say email me. I'm pretty quick on cold emails. It might take me a while to get back to you, but I always respond. But it's really a difficult sell when it comes time to bring it to a partners meeting versus if it's, it's something that someone just emailed me versus it came in through, a Beth or Joe, 'cause Joe's going to be sending all these deals now to me.
It does help widen your network, though, and I really appreciate that point of view, for sure.
But it's interesting. I got to say, we have probably the largest percentage of female founders of any fintech fund. I think we have 12 rock stars.
That's awesome.
Rock stars. They all introduce each other to us.
Okay.
So it is the one. It's. So I sit there. I don't know. I mean, it's so hard to get the cold.
Yeah.
But I mean, we're writing $8 to $10 million initial checks. So it's a little.
I say do both.
Do both.
Do both. That'll double the odds.
Yeah, but we've got a firm. There's 11 people. I mean, Brittany's responding. I don't know.
So Chris, inflation growing, valuations high. It's a frothy market. How's that impacting? I want to hear from all of you. But how's that impacting how you're looking at deals and how you're thinking about deals?
Sure. I mean, particularly in healthcare, right? Depending on the niche that we're talking about, we don't necessarily have pricing power. So I think that has come through in orthodontics, for instance. It's all cash pay. We have the ability to raise prices. We've got some other businesses where we've got 50% Medicare, and we're thinking about efficiencies. I think it's just the staffing, the labor models. How do we think about throughput and driving efficiency to kind of offset that?
Right.
We haven't seen valuations come down. There is, to your point, a lot of capital out there, very competitive, particularly in these fragmented multi-site sectors where we've been very active. So we haven't seen much of a market shift yet, but we are conscious of it and actively trying to offset, where we can.
So you're not just looking at value creation from a growth perspective, but also looking at that efficiency
Exactly.
and the cost side, even more so than you were before.
Yeah, because we're feeling both on the COG side, but also the staffing. Obviously, finding people and the cost at which you're finding them at is becoming challenging.
Difficult. Yep. Other thoughts?
Yeah, I would say, cultivation, we're pretty unique. We're kind of Midwest based, so we have kind of this sensitivity to valuations. I guess we're price conscious in that sense. Right now is kind of a weird, challenging time in that regard. But I will say what we found to be the most successful is differentiating ourselves based off the relationship that we have with founders and how that relates to how we can help them get from this stage to that next stage of growth in terms of sales, building out a sales team. We're really involved since all of our partners have either been operators or founders. So we're very involved even with like that next round fundraise if we're not leading it, of course. And then we're also involved in intros to customers. We're doing as much as we can to kind of not make the founder's life easier and kind of win the deal from a relationship perspective, as opposed to focusing too much on, hey, let's try and just like be the biggest valuation in the room. Because we're not going to win deals that way. That's just not our structure.
Right.
I'll say there. We're very flyover. We're the flyover fintech folks. We look at a lot of cultivation deals. We fund a lot of cultivation deals. We've got a couple in our portfolio and looking at 3 or 4 more. It's silly right now. Being a institutional fintech investor, it's insane. I've met more self-proclaimed fintech investors, VCs, with 6 months of experience that are now slogging term sheets in multi-billion-dollar funds. It's crazy. Here's a stat that's crazy. 2020 to 2021 in the venture capital space, fintech's a big slug of that right now. We went from $2 billion to $28 billion in 1 year of fintech investing. There was a 6% increase in number of deals funded. Decent growth. 110% increase in valuation on the same deals.
Oh my God.
Now, does that tell you we're in a bubble? Guys, this is going to be awful. I'm just telling you it's going to end, I think. I think it ends tragically and poorly, but I tend to be a little more fatalistic because I'm an entrepreneur
Really?
and
I
I've
didn't know.
failed and I'm going to write a book one day called Lurching Towards Success. Because it's unreal. But I just look at that and I go, okay, there is going to be, now we saw a little correction a month ago, and I think it's a dead cat bouncing. I think we're going to get another one. And so just from the overvaluation, just in our sector, and I'm not talking about broad-based, but if you just look at it, I look at these businesses. We submitted a term sheet, really good business, good, clever entrepreneurs. They were crushing it. 35 million pre, they had a couple million in revenue. It was good. They had real growth. We lost the deal at a $250 million pre-money valuation. And then they had the audacity to call me back. Do you want a piece of this? You want in? I'm like, are you kidding me? So they would have to grow a triple to grow into that valuation. And you're sitting there going, what do you, and obviously we have this little board of the dumbest deal we've seen recently. And it's
I'd love to see that.
yeah, it's unreal, some of the valuation.
So what are you spending more time just investing in your current portfolio then? Or?
We did 13 new deals last year. We did 9 follow-ons. We typically invest, when we do a fund, we'll put 60% of the fund to work for new deals. We'll take 3 to 4 years to pick the winners, pick all our values. We take 40% of follow-on capital and our best companies. The worst thing you could do as a VC is fund your losers.
Right.
Because it's just a kamikaze option. I mean, so you back your winners. So we try to write 2 to 3 additional checks and get them there. And then we spend a lot of time just building the portfolio. So we're funding new deals because it's interesting. The capital efficient entrepreneur, typically they're older. They've been through 2 or 3 deals. Our typical, when we're typically writing a check, they're 40 to mid 40s. They've lost, they've failed. I love a founder that's had a smoking hole because they're the most humble, once arrogant, now humble. They
we do mature.
They're very realistic, and you can work with them. The coachability, the capital efficiency. They've chased a big valuation. We've all worked in a high flyer and gotten options that we thought we were gonna, and then it goes public, and then it's 6-month lockup, Rule 144 ends, and the thing's trading at 20% of the IPO price, and you're like, okay, I'm not doing that again. So they're out there. I mean, really good businesses are out there, right?
Yep, that's great. Let's do a little rapid fire. How about it? I'm gonna mention a word that's kind of been hyped in the market, or maybe not hyped enough. And I'm gonna ask you if it's over or under hyped. If it's overhyped, you're gonna give me red, or the audience red. If it's underhyped, that means there's like more legs to it. You think there's some opportunity there, you can make it green. And then if you wanna throw in a comment, not for all of them, but here and there, feel free, okay?
Great.
Got it.
I love it.
All right, even if you're not investing in this stuff.
Right.
Maybe you don't even understand it. Now, there's 1 or 2 that maybe fall into that category for me. What about crypto? Everybody's talking about crypto. Yeah.
Whatever Joe says on this one. All right.
Chris says, whatever everybody else says, that's great. Yeah, so there's more legs to that.
Oh, yeah,
Tons
a lot
more
of legs.
What about metaverse? Metaverse. Yeah?
Wait.
Sorry.
So I'm not.
Should I ask you a healthcare one? You want to beg out on this one? How about private market investing, versus, I guess, public? Over or underrated?
Oh, wait.
Oh, yeah.
Wait,
More
sorry.
legs?
Over means,
Overrated means
Let
it's
me
confusing.
condition this.
oh, yeah.
Yeah.
The markets are starting to institutionalize. Private markets have only been traditionally available to high net worth institutional investors, the club.
Yeah.
As we watch technology coalesce and distribution to open up and transparency and opportunities, it unlocks a huge piece of the market, whether it be real estate, credit funds, private equity, venture capital, seed, crowdfunding. You're seeing it in the crowdfunding. You're going to see platforms start to coalesce where it gives opportunity for the private investor to increase their allocation. Because if you look at the Vanderbilts of the world, they'll go from 6% venture to 10 in a good market, and that opens up the floodgates of money. But when you're an individual and you're like, hey, I'm going to increase my venture exposure from 0 to something, you need a platform. Either that, you're just going to be out there doing stupid deals and throwing away money. And that's what I mean.
Yeah.
So I'm watching the
There's
asset
more
class
legs there.
is
There's more.
institutionalized. I would love if Shore had a slice on a platform that you can invest. And you're starting to see some platforms like iCapital, and there's a few others, Case, and now you're starting to see some Robin Hoods of private investing. And they're coming to funds like us and saying, can we have an allocation? And I'm like, yeah, hell yeah. Like, if we're gonna smack out the big boys and let the people invest, then I'm all for it. Because I think forever the institutional investors have had captive access to this asset class, and it's not fair.
Yeah. Any opposing view to that?
No, I agree with that fully.
Yeah.
Yeah.
What about ESG? ESG, more legs on ESG? Is it over? I know what Joe's going to say.
I'm invested in it, but it can be a little toxic, but I'm in it.
So maybe a green and a red.
I'll say for red because it's important. We need a portfolio view. We don't have proper governance. We haven't defined the analytics.
But does it help with value creation?
Does it help with value creation? It can, pieces of it. Pieces of it, absolutely. I think it's too broad. I think it needs to be subclassified better. We have a portfolio company called Pulse ESG that's,
it's got everything in it, right?
Got everything.
It's everything that's
You'll
good,
find I
good
like to invest in markets I really don't agree with.
All right, what about work from home? Work from home. Overrated. Well, tell us, you said it was underrated. Alana, give us your...
I think it's underrated. I would say work from home, especially in the world of VEC, I feel like has empowered this new level of efficiency. So like I feel like the pace of deals that we saw last year versus the year before, I was looking at, it was like astronomical, like super impressive just because of, stuff isn't in person where we aren't limited to, the geographies that people live in. Instead, we're just on Zoom. And so I think that's really going to continue. I think that keeps me super excited. We're really bullish on undercapitalized markets, kind of like you said, like the flyover states. And it opens up this new exposure to all these founders who are in, undercapitalized regions who are really capital efficient, really scrappy, really resilient. Some cases they're, coming before us and they've hit 1 million ARR and they've only raised maybe like 200K from like angels. And so I think that is like super unique. I mean, that company was in like Utah or something. And I think we'll continue to see this happen where it's like outside of the coast, founders are moving to these, just different regions where it's possible to have lower cost of living. They're able to really build out and find really accessible and affordable sales teams and maybe sales leaders and build to this like 1 million ARR threshold at a really low, really high capital efficiency ratio. That's really impressive.
That's great.
I don't disagree with that. I'm talking about work from home as a full-blown philosophy. I mean, we're convinced that 40 to 50% of every venture capital dollar out there is being squandered into people working 2 and 3 jobs, afternoon tea times, dog walking, full-time childcare, which is all great and good, but not when you're making 6 figures and you got 2 jobs. Like we have one founder who has busted 25 employees with multiple jobs.
Yeah,
inside their company.
That is a real issue right now.
It's a real issue. So if you think
2
you're getting away
full-time
with
jobs,
it,
think about that.
people are watching because it's like, you work for this company. And the other day I was like, I needed an impromptu meeting with somebody and I'm like, hey, where are you? And they're like, didn't respond. And I'm like, the Zoom has started. Like, where are you? And I'm unavailable. I'm like, what are you doing? Like, I'm an operator. I like put a video on you. Like, I want to know what you're doing right now. And they weren't even anywhere near they weren't even near working.
There's certainly lots of investments that related to work from home, but there's also a real risk in terms of this.
I can't fathom building the culture. We built as an operator, the culture in the office is magical. When you're solving problems real time, and I hate Zoom, so you can tell. Zoom is transactional. It is not a relational tool. And people that try to have these little wine parties and like, oh, let's bond and
that was so 2020. Chris, you have something you'd like to add to that?
Very similar philosophy to Joe's. I mean, we've been big proponents of return to the office. I mean, hybrid in some cases. There are some roles in our businesses where
Yeah.
it makes sense to be fully remote if we can have a way of monitoring productivity and holding people accountable. But we've been a bigger proponent of pushing return.
So one for you, Chris. Telemedicine, over or under hyped?
I think it's underhyped.
Lots
Certainly-
more opportunity
Yeah,
there.
and who wins and loses in that? I mean, it's becoming an increasingly competitive field, but I think you're seeing that across, primary care, et cetera, the incorporation of telemed into those platforms, kind of a mix of brick and mortar and telemed. We embraced it across the portfolio. We were forced to, right, in our provider-based businesses when COVID first hit. And we've seen some decline in utilization, obviously, but a good portion is stuck.
That's great. We just have a few minutes left, and I would love to hear, you guys are looking in a lot of crystal balls around what's going to be hot in the future, what the world's going to look like in the next 5-10 years. It can be one of your portfolio companies, or it can be just a cool company that you've read about, seen, researched. A hot company, growth, private market kind of growth company that gives us a real glimpse into the future. I know this is a hard-ending question, but I would love to hear your thoughts.
So I have
on
1
it.
minute.
Cool. Yeah.
I'll do it quick. I'll do a recent portco. One of the first deals I worked on at Cultivation. It's called ChapDesk, and they're really focused on, they're a SaaS company that is building out customer support at scale. And they kind of launched with these e-commerce brands, but they can apply to it can apply to any vertical. But there's been obviously a lot of stickiness around e-commerce because of COVID. And so they had a ton of success, really high growth business. And essentially their core product is so that any person, you or I, who has a few minutes can, potentially be one of their super fans for your favorite brand and just kind of vote up or down to these AI and machine learning generated responses so that customer support at scale can be a truly branded, loyal experience. And any e-commerce brand that has high ticket velocity can really scale that up, but also have a low cost solution as opposed to having a full-time customer support representative on their team. So they've had a lot of stickiness, and they're creating jobs, which is also a really great thing to be able to say when you're in the world of SaaS.
We saw a trend, said, hey, commercial lending money to businesses. If you look at the consumer lending track and web-based and purely digital LOSs is what they're called, loan origination systems. I said, it's going to be a big market. We invested in a business called Numerated Growth Technologies. It ended up being the fastest growing SaaS business, fintech. They were number 12 on the 5,000. When banks shut down, bankers had to do these PPP loans and all that. They couldn't get to their systems. And I felt like a ventilator dealer. Like literally, I was having every bank in the country say, can we get on your platform? We went from 2 million in revenue to 68 million in revenue in 1 year.
Wow.
And it was electric. The board had 4 calls a day just getting the money, getting the metrics and the updates. We were processing 1,000 loans a minute on our platform at some point. But you saw, but it was fascinating. So commercial LOS, loan origination system, digitizing that process will be changed forever. It's like the QR code at the restaurant.
You can't go back.
You can't go back.
You just can't go back.
It was pretty fun to be a part of that one.
That's awesome. All right, Chris, round us out.
In the healthcare space, behavioral has been a big area for us, increasing recognition, whether it be autism or addiction. One of our most recent investments, Transformations, is a mental health company, and obviously through COVID, we've had a lot of challenges. I think it also plays on your telemedicine, meeting the patient where they are, when they need you, using telehealth, but also having physical clinics and just overall access and professionalization of that network. So we're pretty excited about that.
Yeah. No way to go back on that either. Yeah, and to really help the mental health component is key in the future. Excellent. All right, well, we're out of time. Please join me in thanking our wonderful panel.
And thank you, Beth.
Awesome.